Welcome, everyone. I am Tracey Velt, Senior Director of Data and Content for HousingWire, filling in for Sarah Wheeler while she is out this week. Today's guest is Logan Mohtashami, and we are talking all about the market volatility and what we might see with mortgage rates gone wild. So enjoy the podcast. So I've got big shoes to fill today for Sarah being out. And it's been absolutely wild in the market. So let's start with that. Let's talk about what is going on.
Yes, it is. I always say if I'm making 7 Instagram live videos within a 24-hour period trying to explain everything, all hell's breaking loose. And what I'm going to try to explain here is, unfortunately, at times, the mortgage market gets caught up into market volatility. And what's happened with the stock market and bond market, this whiplash, was something I was worried about. That I had to make a video like on Sunday night and say, hey, listen, if there's any kind of good news or anything, literally the bond, we're going to get such a reversal, it's going to rip your face off. And here it is, the 10-year yield was at 3.87. And I hate to get in my little geeky trader sense, but I was like, okay, that's the intraday top or bottom that's being tested. And then we're starting to hear more about deals. Right when I say this, Trump announces a 104% tariff on China if they don't make a deal. So when it turns, it's going to turn fast. The problem with this is that the spreads tend to get bad in this kind of environment. So we had we went from, I think, 6.55% on mortgage rates, and today we're at 6.85. So in the big scale of things, it's not like major, but everyone who's in the industry and knows, boy, you get a pricing level there, and then all of a sudden within 24 hours, it just reverses on you in a very fast way, or 24 hours in the business day sense. And if we didn't have Liberation Day or tariff headlines, the job market or the jobs data last week was good enough to where the 10-year yield being at 4.35% was warranted, right? We have a lot of economic data lines that are getting softer before the trade war headlines, but we saw such a reversal. I think the high point this morning was like 427. This is not normal for everyone in the industry that's watching. But when you have headline volatility and money going in and out of stocks, this can be the case. And I think one example that I try to explain to people is that imagine if you're a bond investor or a stock fund where you've gained so much in the bond market and you're sitting there looking at a bear market in stocks. You sell your bonds, you raise cash, or you sell your bonds to cover margin call, whatever it is, you're sitting on big gains. You want to rotate the money around. That's also in play. None of this is normal. None of this is healthy. Last year was so much better in the sense that the 10-year yield was falling and it was slow, and the spreads were getting better, and it was a more functioning market. But until this calms down, these headlines can do this to the up and downside with bond rates.
And do you think there is that a lot of this is really confusion over what Trump's ultimate goal with the tariffs is? Because he, on one hand, says he wants to correct the imbalance, which would mean the tariffs would stay in place. On the other hand, there's like, oh, we're going to negotiate and we want 0-0, which means that the imbalance, I guess, would just go away because there are no tariffs either way, but the old imbalance was still there and not corrected. So how much of that is really just confusion?
I would say this, the global markets were not ready for Godzilla tariffs. And I go back to when there was like a 10% tariff across the board announced, the stock market futures were actually rising and bond yields were, because they're like, okay, that's not, whatever it is, that's manageable. But the reciprocal tariffs were so big and so extreme that it's always shoot first, ask later after you had a few drinks, and then come back and see what's going on. But it was such a wild few days that you like the 10-year yield literally almost got to my forecast low of the year at 380. And I was like, well, if the labor data was breaking and stuff like that, then yeah, I could warn that. But it was just money, right? Money flows, money chaos. The market was up so much, people sold, bought bonds. Bonds had such a great gain. So, and that it's hard to make sense of it. But if you have the chaos factor into the stock market and bond market, we're talking trillions of dollars that could be moved like this. So until you get a little bit of clarity, and I think that's what Secretary of Treasury Bessent did. The storyline is that he flew to Florida and kind of told Trump, let's talk more about maybe deals. I think as we talked about in the last week's podcast, I think in the end, that's the goal. It was such an egregious tariff percentage right away that I just don't think that was ever the plan. But if you think about blitzing people and forcing people to do deals, today's a good example. You got 104% tariff on China now. You're trying to kind of ram them into making a deal, and this is the tactic that's being used. But now I think what Bassett and some other people does, let's kind of the other people, let's get some deals done so people think that there's actually a coherent game plan toward the end of this. And in a few days, it might be a little bit more understandable, or in a few days, we might see more crazy stuff. But until then, this market volatility is part of it. And I advise everyone, you got to keep your eye on any headlines news, because as you can see, things just move like this, seconds. And for people that have to lock rates or quote rates, man, it's got to be brutal out there.
Yeah, I saw a headline about South Korea is negotiating, sending a team over to negotiate that and other issues. I think you said it was just kind of one-stop shopping.
Yeah, this is just how President Trump operates, and this is in a very, very aggressive. Again, we're already seeing fights between Elon Musk and Peter Navarro out there. So there's chaos. Yeah. It's just chaos. And for those that remember 2018 and 19, 2018 was like this. This is why we kind of did that podcast out of Trump. Get ready for some headlines. And back then, the markets didn't like. It was a very tactical, small trade war. We're doing NAFTA 2.0. It wasn't as extreme as this. And even back then, the markets threw a fit. But the thing about 2018 and 19 is business investment went down to zero. President Trump did not do the trade war tap dance until 2018. He made sure to get the corporate tax cuts in first. Then he went at it because he knows, everyone in the White House knows, the markets aren't going to like this, and business needs a little bit of a cushion while this goes on. And eventually he went and did some deals, and the economy, if anyone remembers, the economic data was actually getting better toward the second half of 2019. And the first 2 months of 2020, before COVID hit us, all the data lines were good. Jobs were beating estimates. Manufacturing data was up. Retail sales was up. Housing broke out before COVID hit us. So there's a playbook. When there was a rumor of a 90-day tariff hold, stocks just shot up within seconds, and then they said it was a fake data line. Was it a test balloon to see what could happen? Maybe, but it's just this is not normal. So I understand if you have a life. I don't have a life, so I follow this stuff 24/7. So, but if you just went to lunch and you came back and you said, "What just happened?" It's an extreme volatile period.
Yeah, I don't even look at my investments. I've chosen to not look. And how, I've heard a lot of reports of, we were due for a market correction anyway, probably not this extreme. How much of that plays into it? This is a good excuse for that to happen.
So for all my stock trader friends that are listening to this, in 2017, the market was very stable. There was no volatility. Then we went into the trade war, and then things started to pick up. So this is something we actually talked about in the podcast a few months ago, that everything is quiet, but if the headlines start to get aggressive, watch this. I just think this was such a big Godzilla tariff plan that nobody, not even the people that were forecasting the worst case scenario, thought this would be it. And I think that's the volatility. And they're sitting on so many gains over the last few years since the lows in 2022 that you shoot first, you ask later, put money into bonds. Bonds rallied so much that everyone's like, oh my God, I'm sitting on big gains here. So, it's just one of those things where the news itself really took everyone by surprise. But I would also address this to another fact. There's a lot of people out there that are sending videos out that's saying we are purposefully trying to destroy our economy because we have to refinance government debt. This is a lie. Okay, progressives and conservatives have group people doing these marketing themes on all social media outlets. We do not have to worry about like one of our bond auctions blowing up, or we're going to become like a third world country where you have a debt situation. We can handle this. And the Treasury Secretary Bassett said we're moving a lot of our issue debts to short-term debts. We'll be okay. So I think that's kind of like a cover of trying to say, hey, listen, if the 10-year, there's a lot of people that represent the White House on social media say, well, hey, it's working. The 10-year yield's lower. It's just that when you put a shock like this into the system, bond yields go down because people perceive that lower growth is coming. So be careful of the people that say we are intentionally trying to destroy our economy because we need to refinance our debt like we're a third world country, that we have problems. No, we're the United States of America. We're the biggest economy in the world. We're literally like $400 or $500 trillion worth when you put everything together. We'll be okay, but it's just the shock of the event is making the markets go crazy, kind of like what it did in 2018 as well. We had an almost near bear market the day before Christmas in 2018. So here's just an extreme version of that.
And let's talk about mortgage rates and kind of their volatility as well. What are you thinking? What is your prediction for?
Well, because the 10-year yield almost got to the bottom of my forecast, the rates didn't get close to the bottom end of my forecast either, because the speed of the 10-year yield falling, and then the spreads got worse, right? So last year, we got towards 6% with the 10-year yield. I think the intraday low was like 362. Here, mortgage rates did get to the low of the year, but then they shot up, and we're talking 30 basis points. In the grand picture of things, it isn't too crazy, but we're in an industry where if you're locking something, boy, and it turns on you like this, it's problematic. So the volatility of the pricing was damaging in that sense. But going out in the future, right, the bottom end range is 380. The economic data was getting softer before this trade war stuff happened. If that softness gets worse and worse, where the labor market starts to break, the 10-year yield can go lower out there, but we get down to that 380 level, or we get towards 6% mortgage rates again, which would be in a sense, almost actually the third time this has happened since 2022. Then we start to say, okay, what's that next stage? What does the Federal Reserve do? Are they going to cut rates and become accommodative? When there's jobs lost, how are they going to react? Then that could go into another level of lower rates. But until then, we work off the economic data. It's unfortunate that the markets are really dictating everything now, but in time, this should calm down, and we'll take it with the economic data after that. But man, I did not expect to get close to my bottom end range before tax day happened, because quite didn't see the velocity of the downturn in the labor data yet. But here we are, and we'll take it one day at a time. And thank you all for the Instagram family. We're almost at 1 million people a month now. We try to keep live updates because every time we hear a headline, we want to see what the bond market does to it. But again, the lower mortgage rate theory is just a lower economic growth and labor data getting. If the Fed had cut 1% lower on the rates, then you could get to 6% easier. But we're not there yet. And there's going to be a battle between Trump and Powell for the rest of the year, and that's a popcorn. Let's see how that folds out.
Much like your conversations with Diego.
Yes, very much so. By the way, Diego and I have these epic battles on Slack, and you guys will all trust me. Everyone would love to just sit there and watch that.
Very interesting. And I learn a lot from them too.
Yeah,
So,
again, my stuff is always designed to be informative, right?
mhm.
So no matter who I'm talking to, even if I don't agree 100% with the person, my job is to assume that people are watching and learning. And even the person that's
Mhm.
talking to me, it's done in an educational format to teach. That's the old high school basketball coach and historian in me. Teaching something is very useful because then it could stay with the person for a very long time.
So, how is the housing tracker data looking, Logan?
This is the surprising thing. If somebody would have told me that all of our forward looking data lines are positive year over year by April 1st, I wouldn't have taken that bet if they told me mortgage rates would have been above 6.64%. So we have this tracker article every week. We have these forward-looking data lines, purchase application data. We have a weekly contract data, things that go into contract, and then we have a total monthly pending sales data as well. They're all positive now on a year-over-year basis. This data line does not it's not going to go into the existing home sales report that's coming out in a few days, but this is like weeks and months ahead before you see it in the sales data. And for it to go positive now, the last 2 years, I've already written an article saying, okay, we saw the peak in existing home sales. That was it. Rates have gone up. The forward-looking data is negative. We're not going to go back there. This is the first year in many years that all of our forward-looking data lines are positive. It's nothing spectacular. It's not blowing up higher. It's nothing in that matter, but it is positive. This to me means that if mortgage rates can just head down towards 6% and stay there, I believe everyone's sales estimates and forecasts will be wrong because the forward-looking data is getting better. It's a really good year in my sense because I'm a team higher rates, higher inventory person. So I'm getting my inventory growth. The new listings data is going to get, I believe, to 80,000, which is the seasonal peaks in the previous decade, were like 80 to 110,000. So positive there. But I am surprised that both purchase apps, weeklies, and monthly contracts are all positive year over year, and rates really haven't broken under 6.64 and head towards 6%. That's the kind of the shocking thing to me. I would not have taken that bet early on. So we'll see how this, by the time this podcast comes out, purchase application data will be out again. We'll see what happens. When markets get wild like this, you just don't know how people are going to react. But it is a very, very encouraging sign to see what I love to see: rising inventory, rising new listings, rising sales data. That looks like a normal housing market that I just can't wait to get back into again. All this chaos can be a little problematic on sleep, but that's the positive news so far year to date. And this last week, all of our data lines went positive together.
Yeah, I don't even know what a normal housing market looks like after the past several years.
Yeah, and it's funny because a lot of people thought the 2018, 2019 market was so wild and crazy. And, because mortgage rates
Yeah.
got to 5% slowly, but they got to 5%.
Mhm.
And COVID has ruined so many data lines, and it's also created some extreme moves on data lines that we never thought could be possible. But that's a global pandemic. But housing, 2024, I thought was good in the normal sense, and 2025 is. We haven't seen any what we call a rush of sellers. New listings data during the housing bubble crash years were running at 250 to 400,000 per week for years. Even if I took the peak new listings data in the last 5 years and doubled it, it wouldn't even come close to the bottom end range of back then. So homeowners, again, solid. Most part, all of them are doing good. They're just kind of going to work, doing their thing. The markets, on the other hand, chaos. We say middle age. See, this is a really good example. Middle age podcast stock traders. They sell things in a second, right? So when they talk about housing, oh my God, everyone's going to rush to sell their house. No, that's you. You did that this week. You sold all your equities, you put it into bonds. Homeowners don't act that way because they have to find another form of shelter. You can sell your stocks like this, doesn't matter. You go to your kitchen, get a drink or whatever, but housing just is not as liquid And again, the supply is a function of demand in housing because 70 to 80% of sellers are buyers. So it's a whole different marketplace. Like that's just structurally different.
Yeah. Well, Logan, thanks so much for sharing all of that. And I look forward to the next 2 podcasts that we're doing together.
Yes. So. And also for everyone listening to this, for the first time ever, Ivy Zellman and Logan Mohtashami are both speaking at the same event. This has never happened. All of you can come watch that. You could register free. There's the link is in HousingWire. We have another Wall Street analyst joining us, Dale. So it should be a really, really good conversation with 3 people with 3 different views. And we'll have that on Friday.
Can't wait. Sounds good.